Good evening, everyone, and thank you for joining us on this live webcast. My name is Shubham, and I look after HSBC's branch network for Western India, and I'll be your host today. At HSBC, we continuously strive to add value to your banking experience by bringing experts from different financial domains to share their knowledge and experience. A large number of our customers have a global mindset and needs which transcend international borders. Now, this could range from cross-border movement of money to global investment opportunities. When we speak to our clients on such topics, we do get a lot of questions and queries on how do we see the currency markets behaving. Hence, I'm delighted to welcome you to the first currency webinar for this year, where we present a macroeconomic update with a specific focus on simplifying the global currency movements for you. These webinars are specially curated to share some key insights so that we equip our customers to take informed decisions. In the recent past, we had conducted a similar webinar in the month of November. And if you do intend to look that up, you can find it on HSBC India's YouTube channel by searching for FX Currency Outlook 2022. We saw a heartening response to that and also received some great feedback from our clients on what they would like to hear from us in future sessions. Now, keeping that feedback in mind, we are now launching a series of webinars titled Demystifying Currency Movements, where along with the broader update, you would also delve deeper into how some of the macroeconomic factors influence the global currency movements. In the post-COVID era, or rather, I should say the ongoing COVID era, and a war raging in the continental Europe, global trade patterns are shifting, and we in India are not immune to it. There's been a lot of noise around topics like widening trade deficit, depleting currency reserves, foreign investors investing or rather pulling out, whether these are portfolio investors or FDI. One macroeconomic factor which encompasses such topics is balance of payments, which basically records all transactions made between entities in one country with the rest of the world. So for today's session, first one in the series of Demystifying Currency Movement, our expert will throw some light on what impacts our balance of payments and then the follow-on impact on currency movements. So let me now invite my esteemed colleague and our expert, Mr. Manoj Goel. Manoj is the head of corporate sales for the markets and securities services businesses at HSBC India. In his role, Manoj is responsible for managing the FX flow sales and derivatives business for corporate clients. He has a financial markets experience of more than 18 years, specifically across FX and structured solutions. He's been with HSBC since 2005. Manoj has also been very actively involved in the development of FX and derivatives market in India, given his association with various industry bodies, such as the Foreign Exchange Dealers Association of India. So I would request you all to keep your questions ready for Manoj, which he can address shortly after his opening presentation. You may post these questions in the comment section of YouTube or the Dreamcast platform, whichever you are using to access this session. So without much further ado, let me now invite Manoj to take the session forward. Over to you, Manoj.
Thank you, Shubham, and very warm welcome to our audience. And starting off the session, while we'll dwell deep into balance of payments, maybe we'll just start into a quick update how markets have been behaving in 2023. So Shubham did refer to the session which we had done somewhere in November. And I must say the markets have completely gone a sea change since then. And more importantly, around sentiments for currency markets. Way back last year, or even starting from 2021, I would say 22 was clearly the year of dollar strength across the board. I mean, I would not dwell too much into the reasons over there, but we saw movement, and this time the difference was it was not only the movement in emerging markets currency, which normally you see when dollar gains, but we saw much stronger movement in G10 currencies such as Euro and GBP. And in fact, if you would recall, GBP at one point in time was looking very close to breaching parity on dollar. And of course, Euro did go below parity against dollar and remained there for quite a while. But starting from last, I would say, December, I think we have started seeing dollar giving way. And one of the main reason has been change in outlook on dollar rates and also some bit of respite in inflation, and which of course led to the change in the outlook on dollar rates. So while the central bank is still in the in this mode of, the US central bank, Fed, is still in the mode of increasing rates, and there are expected some further rate hikes. But normally the way we see in currency markets, it's not about what the next action is going to be. That's normally discounted. It is like how the rates are going to behave in years to come. And that's where there's a change of outlook. And while the short-term rates, dollar rates have remained elevated, and as I mentioned earlier, looking to go further up, but the longer-term dollar rates, which is, let's say, 5-year dollar swap rates or 10-year swap rates, which provide a bit of trajectory for future rates, have started to come off significantly. Just to give some perspective, the 10-year dollar rates had gone above 4%, 4.1% plus. But currently they have moved in the range of 3.4% or so. So that's a very, very sharp movement. And dollar rates were one of the reasons why dollar was gaining across the board, across other currencies, because the pace of hike in dollar rates, while the rates were hiked across. If you look at Eurozone, they moved away from the negative interest rate for the first time last year. And even UK or in India, everywhere we're talking about rate hike cycle by central banks to fight inflation. But the trajectory of rate hike was seen much higher in dollar rate, and even the terminal rates in dollar was seen much higher. So that is what has led to this bit of change in dollar rate outlook. And if you look over here, if you see the chart on the left, which is the currency movement from January to December, we'll see across, negative across all currency pairs in that sense. But if you look at the movement since our last 20 or so days for January, everything is in green. And in fact, this may not reflect the true picture, because this move in dollar started somewhere in early December. So if not for that move, in fact, we would have seen much more red on the left hand side. So it negated some of the dollar strength, which we have seen throughout the year running into December. So overall, I think the big picture change is the dollar strength, which was going across, has stalled for a moment. The currencies have moved back, and in that manner, if I talk about specifically about dollar rupee has also gained. It had gone towards 83 last year. Since then, it has come off, and right now it has been moving around at 80, 81, 81 half handle. Not It has not gained as much as some of the other currencies. Let's say what the retracement which we have seen in euro or GBP, to name a few. The move back or the strength in INR is not that much. It's a few percentage points. But at the same time, last year when other currencies or dollar was strengthening, rupee had not depreciated to that extent also. Now, the obvious answer could be, and as the stated policy from central bank is, they do try to manage the volatility. So maybe it could be said last time around when a dollar was strengthening, the rupee did not depreciate to that extent. And now when we are seeing dollar retracing back, we are seeing rupee not strengthening that much as well. So I would, so overall, going from their perspective, we need to see and watch how interest rate outlook moves, how the relative interest rate outlook moves, more importantly, and the outlook on inflation. As I mentioned earlier, the inflation has started to come off from the peak in across. I mean, if we talk of inflation in India, the last inflation rate was the consumer inflation was less than 6%, so pretty much coming back into the RBI tolerance zone. And even for if we talk of US, the inflation data has been coming off every month, and that is what is driving the currency. But as Shubham mentioned, I will just pause talking about what's happening in the currency market, but would like to move into the next topic, which we're trying to talk about, which is what are the factors which are driving currency markets. And there are many factors, as I talked about. There are interest rate movement, there are global dollar strength, there are portfolio movement of money, the expected growth rate in a country. There are many factors, but one of the factor which we hear a lot and which comes around a lot in our discussion is trade deficit, foreign direct investment, the foreign portfolio investment. So what we try to do is try to go deeper into some of those aspects and maybe try to explain what are the minor or micro level components over there, just to say that you are able to get a better grasp of some of those concepts. Now, leaving aside the terminology, if we just talk about any market, I mean, any market, the idea for any movement is supply and demand, right? So, and currency market is no different. When we talk of currency market, there's somebody looking to buy a dollar and there's somebody looking to sell a dollar. The relative movement of that would be dependent on, are there more people who are looking to buy a dollar or less? I mean, essentially that's like any other market. And that is what we encapsulate in balance of payment. Balance of payment is nothing but, as a country, we are supplying dollar across the globe, and at the same time, and I'm using the term of dollar in a slightly loose manner. It should be foreign currency, but because most of the world reserve currency is still dollar, and lost a lot of other currency get washed in a manner through cross currency execution. So I'm using the term as loosely as dollar. So there will be many reasons why we need dollars, and there are many reasons why we or get dollars. And balance of payment is essentially a net amount of that. Now, there are two broader classification when we talk of balance of payment. One part is current account, where some of the topic such as items when we import or export physical goods, those come in trade account or trade goods. But at the same time, when we're doing services, now services can be of many nature. It could be, let's say, services on account of software exports that come as part of services. It could be other financial services being offered. It could be various other nature. That amount comes in the trade in services matter. And then we have income and transfer payments. Now, this will be on account of the some of you who may be sending money to India for maintenance of your relatives or for investment, for other purposes, and vice versa. When somebody in India is sending out money outside or traveling, etc., that may come into income and transfer. And there's one more other important component, which could be in the form of companies who look for who have invested earlier in India, they are generating income and they send out that in the form of dividend. So that comes into the income transfer and payments. Now, these are three main components which we talk when we talk of current account items. And then we have a separate account which is known as capital account. But I'll just talk about current account right now over there. And as I said earlier, within current account, we have trade account, we have service, and we have income and transfer. Now, these are the three key components which we talk about. Now, as expected, when we talk about trade account, and it in a way reflect the import and export of goods. So if I go slightly more deeper into that, some of the key components which come into our trade account will be oil prices, oil import, the things which we import, gold, that always has been a big topic. And whenever currency goes come under stress, we always talk about the central bank, the government, or other market participants start talking about gold. They could be electronics, chemical. I mean, that's also becoming decently large. So those are some key components which goes into the items which India imports. And any change in the movement of these prices would mean that what we are importing is becoming higher. At the same time, there are various items which we export. I mean, we do refine oil and send out some components, petro products. We have jewelry. We have engineering goods, agricultural, textile. I mean, these are some of the factors which we export when we talk of physical goods. Now, given the amount of oil which we import, and of course the electronics item as well, while we all know the PLI schemes, etc., are increasing, are helping India to move up in electronics export as well. But still, the trade account, the balance of import and export generally is negative for the country, which means the demand for foreign currency by us is more than what we export. And that has been the case for trade account. Of course, there have been a little bit of periods such as 2020, the COVID time, when, because of lockdown restriction, other thing, we saw trade account becoming positive. But generally, trade account is negative for India. Of course, it gets supported by trade in services, which generally is positive given the large amount of software services which India provides to the globe. So generally, trade in services is a positive account, and as you can see, the case for last financial year, it was quite a large positive number, and we continue to see improvement in that number. And last was income and transfer. Again, that generally is positive for India, given the large amount of money which the NRIs and other people have been sending through inward remittances. That always is positive. But we have seen increase in Indians looking to, of course, travel for investing outside, for education purposes, etc. So the outward remittance has also been increasing. But as an overall basis, the in the income and transfer has been positive for India, as has been the case for the data mentioned for last financial year, around $43 billion over there. But if we add all this item, while we talked about the service account and this income account is positive, but on an overall basis, the trade account is significantly negative, which means generally our current account is negative, and has been the case for the last financial year as well. But as we know, and the uptick in the financial in the oil prices, the current account by that virtue is expected significantly negative in this financial year. Now, I will now move to the capital account. Capital account is essentially talking about foreign investments. That remains one of the large component over there. And there are two parts over there. When you talk of foreign investment, it is in the form of foreign direct investment or foreign portfolio investment. Foreign direct investment, I mean, as simply companies putting capital in acquiring companies, manufacturing, other things, setting up, a physical asset that generally goes into FDI. Generally, India has been growing in this segment, and of course, there have been periods where we got slightly higher FDI, but generally that has been positive, which provides some support to current account. But the other large component is, of course, portfolio investment, which is generally investing in financial market instruments. Now, that can be in equity or debt market. Now, debt and equity FPI investment combined comes into foreign portfolio investment, and these two elements, which we put down in foreign investment, remain a very, very large component of net supply of dollar to the country and providing a counter to the trade account, which you talked about earlier. Because if not for this, we would have seen a negative amount on trade input. I think few other components I'll talk about is borrowing by corporates in India, which could be in long-term borrowing, which you call as ECB, or bias credit or trade credit, short-term borrowings. And then we have other components such as, let's say, external assistance or some other capital. But if I look to summarize from a larger balance of payment perspective, it is essentially the current account and this foreign investment, which together uh, contribute the larger chunk on where do our balance of payment stand. And if I just go slightly deeper, to just provide some trend over there, if you look at this particular point on the above chart, the blue one is the movement in the oil prices, and the line below in a way reflects the change or the movement in the our trade account. As expected, as the oil prices have started to move up post earlier 2020, especially last year post the crisis which we saw in Europe, in Ukraine and Russia war. As oil prices started moving higher, we saw our trade account worsening. And to add to that, as our the economy opened post COVID, given the pent up demand and other things, both on trade import of goods as well as travel picked up, and that also made that our even other item from current account started becoming negative. So overall, I think we have seen our current account worsening over the years, especially last year. Now, if you look at the trend in net foreign direct investment, I would say they're pretty much stable over the last few years. These represent the monthly FDIs into the country. There was a period between June and around June and September quarter in 2020 when we suddenly saw a very sharp move up. These related to few specific amount of inflow which we saw around the time. And if you look at the right hand side of the chart, this represents how the movement in foreign portfolio investment have been. Now, these are two elements where we have seen relatively regular last few years. On an average, we have seen negative amount, which means on the FPI amount on the debt side, we saw a large amount moved away in 2022 and 2020, and we have not seen that money coming back. It has been pretty much flat after that. But if you look at the equity side of FPI flows, they have been negative lately, and that has been adding a bit of pressure on currency. So if I just summarize how the situation has been, so on the balance of payment for India last 1 year, our trade account has been worsening because of increase in oil prices, commodity prices. Services, they are still positive, but we have seen, especially on the outward remittance increases as the demand for dollar for travel or for the other purposes, etc., has picked up. And also we have seen some of the investment or the companies which have been generating revenues in India for some time started to send out capital more in the form of royalties or in the form of, let's say, dividends, etc., which is also causing overall our current account to worsen off. Decently supported so far by FDI and a little bit by FPI, but the balancing figure in a way get managed by the central bank, and that is what we talk about the intervention, and the balancing figure is always in the reserves. In 2020, when balance of payment was quite high in surplus, we saw the RBI reserves increasing, and you would heard last year the RBI reserve has been coming down because of a balance of payment was started to worsen off. And this year the expectation is balance of payment will be negative, which means the RBI reserve have to come down, which has been the case. We have been seeing the reserves have been coming down. So I think that is what we wanted to maybe talk about in balance of payment right now. Shubham, maybe I can hand you back.
Yeah, thanks, Manoj. I think that was pretty insightful presentation, and I'm sure some of these aspects around current and capital account trends and balance of payments, which everybody keeps reading in various news articles and reports, and has now been truly demystified for those who are watching us, and that should hopefully equip them to take more informed decisions. So we've already received some interesting questions from our viewers, which I will request Manoj to address shortly. But in the interim, I would request everyone to kind of keep pouring these questions in the comment section. And along with the questions, we'd also like to hear your feedback on this session. And if there are any specific topics that you would like us to cover in our next session as well. So keep sending those to us. Now moving on to the first question, Manoj. You did mention that rupee kind of neither did depreciate and appreciate much last year compared to other currencies, and now once again it's kind of somewhere in between. What do you think the factors which will support INR this year, and are there many major risks to be considered?
Yes. So the way I think, Shubham, there are 2-3 parts when we look at the factors which will affect rupee, right? The biggest factor is how dollar is going to behave globally. This recent move down in dollar which we have seen across currency pair, is it going to remain or no? Again, it will depend on the outlook on US rates and inflation, and also how the wage growth or the employment data continues to come out of US. So those are some of the factors which will determine what happens to dollar globally, and that in turn will drive Asian currencies, and rupee has to participate, plus or minus with some degree. That will be the one major factor which will be there. The second important factor will be oil prices, and again the trade account which you talked about. Last year we saw significant deterioration in this because the factor which I explained, not only oil prices but the move up in import of goods. Post COVID we saw significant amount of that, travel, other things, etc. Now and general commodity prices. It's not only oil prices we are talking about. I mean, every other commodity prices, where it was. Since then, they have come off. So clearly, the trade account is looking better, but it is still not moved to a level where you should see looking at the fall in the commodity prices. But always there is a lag effect. Normally, when you import, there are payment terms which takes 2 to 3 months, and normally we have seen a bit of lag. Our monthly trade balance, which had gone up to like $29 billion, which has come down to 23 billion or so in the last 1 or 2 months. And just to remind our audience, way back if I go pre-COVID level, the trade account used to be somewhere around 14 or 15 billion dollar a month. So that's the additional demand of dollar which we saw on account of trade account, right? 14 billion to 29 billion dollars, reflection of everything what I talked about. So it has started to move off. So it would be a big component of how dollar rupee behaves. If we see it stabilizing further below towards that $20 billion, that's a big relief and big saving on a daily demand and supply. Third factor, again, connecting back to my earlier slide about on the capital side of the things, which is FPI and FDI, right? Now, FDI, even last year, right, it did slightly slow down, but we didn't see a major shift. But what we need to think through is because there is still abundant global liquidity available, which is finding place where it had to go, or it will continue to go through. It's just that people are becoming a bit more cautious, and they're demanding a lot more caution when putting down money. And we've seen, in the valuation, other things of various startup or new age companies, some of the changes which are happening over there. But generally, people don't have too much of concern. Maybe we don't see too much of growth on FDI, but people are not expecting it to come down significantly. But the biggest impact on the capital account, which can be due to portfolio investment. I did talk about FP and debt. That has been quite stable. It has not moved too much. And frankly, the amount, after the amount which went back in 2020, the overall money invested in the country is a very small portion of the overall money. Now, what we have seen is as dollar rates and on the outlook on dollar rates have started to come off, we have seen some bit of money start to flow into other emerging markets. I mean, if I talk of, let's say, Indonesia or some of the other countries, we have started to see flow. So there could be some expectation that maybe this year there could be some positive, amount on that. But the biggest impact, of course, will be on the FPI and the equity side. Now, generally, we have seen money went out last year, and we have not seen large movement started to come in yet. But if the outlook changes and we start seeing some positive aspect of that, that can add to some more flow on FPI equity. So those are few things which we need to see, and of course, ultimately the view will be from a central bank perspective, because they also try to balance it out, rupee movement on various parameters, rightly so, because while generally the view is they don't like to target any particular level, but volatility is something which they like to manage, and also the relative valuation of rupee in relation to our trade partners. So it will also be a function of what is their views, etc. And at some point in time, they may start to see, okay, that might be a good level to start building up the reserves, which were given up last year as we were coming negative on balance of payment, right? So those are some of the factors which will determine how rupee moves.
Yeah. Now, staying a little bit further on this whole topic of the trade deficit bit, right? The numbers for December were kind of recently released, and the deficit seems to be pretty sticky with the fall in exports along with imports also having decreased. Now, we are also talking about a global economic slowdown. How do you see, this whole scenario panning out going forward?
So Shubham, there are, again, when we talk of trade account, see the components which go over there. Again, one is the commodity prices, right? The value in dollar terms, right? As we saw last year, it had worsened significantly just because the commodity prices, if your commodity prices are high by 30-40%, the overall amount will go. Some of that get negated because we export some of those items back, right? So it's a balancing act. But there are particles out there which we just consume. Like oil is one amount, right? If oil prices goes to 120 from 60, right, which was the case or even in 2020-21, your import bill has to go higher from there, and that is what is reflecting in the overall trade account. And then the other part is, as economy picks up, normally the capex increases, demand for goods increases, which was the case last year, which also mean, and normally we have seen whenever India growth story is picking up, we see trade account becoming worsening because naturally we import a lot more for our capex, manufacturing, other things, etc. Now the government has been focusing a lot on that and try to see how we can increase export, and this PLI scheme was clearly one step in that direction, where we're trying to see if we can manufacture more, not only for India, but for the world, right? And that is what, and we keep hearing this news article, the amount of iPhones now being made in India and exported, they have grown significantly higher than what they were 2 years back. And given the current lockdown, how situation is moving, and more companies are looking to set up things in India. But I'm sure everybody appreciates that's a very, very slow process. It does take a lot of time for these things to materialize. So I would say in the short term, we will continue to face challenges on trade account, right? But would it become better than what we have seen last year? Yes. As I said, it's already have come down to 23 from 29 billion or so. Now, we are right now getting around this 23 billion handle the monthly trade deficit for some time now. Possibly, and again, we need to see if the economy starts slowing down, which again is not a good thing, right? But I mean, maybe it might be positive for the trade account. And if the lag effect of all these commodity prices, the drop in commodity prices start factoring in, so there could be some expectation that the trade account may start coming down.
Now, moving on to this touchy topic of dollar reserves, you did speak about this fact that the way it seems panning out for the next year, our reserves may not increase. We'll still have a kind of a shortfall. Now, with this kind of an outlook, do you see that there's a very limited scope for rupee to appreciate, because RBI will still want to kind of not let their reserves deplete any further? Reserves is a very touchy topic. I say that because people are still not forgotten the early 90s, the balance of payment crisis. So what's your view on this bit?
See, first of all, again, what is the right number of the reserve? Is reserve, of course, our reserve currently have come down where they were start of the last year, or at the peak of, let's say, 2021, right? But then, is current number adequate? Should we be worried about on that, right? In that context, last year, yes, and we were all used to debate in 2020 or 2021 when our reserve crossed $500 billion, then they moved above close to 600 plus, etc. What is the right number? Should we stop building up reserves over there? And there were a lot of economists, etc. They have come with their theory, and there are a lot of theories. Should 6 months of import, 9 months of import, etc. But as is the case, everything is relative, right? And that was one of the reasons while rupee did not depreciate to the extent while some other currencies moved last year, was the very, very large amount of dollar reserves what we had. And central bank did use that very actively to manage the currency. I wouldn't say that the dollar reserves have moved at a level where it's a matter of concern. I think even then, when you look at many other countries, I think it represents very, very healthy metrics. still very respectable. That's the reason we don't see too much of relatively the speculation activity, etc. In rupee can be relatively muted than some of the other currencies, right? But yes, because they have come down from the last year, at some level, do you think the central bank will look to build up reserves, and which may cap the rupee appreciation, which we might otherwise see? If you look at December, yes, I think relatively some of the other currencies had gained much more than rupee. Pretty much, I mean, if you talk of GBP, for example, it had come almost well below 1.05. It's now trading closer to 1.22. A euro, which had gone below parity, 0.96, it's closer to 1.07. Almost 8-9% moves from the lows, which was not very far away, right? In October, November, that is where these currencies were. As against that, rupee has moved from 83 to 81 half, that's 81 quarter, something around there, right? So maybe 2 to 3% movement only. So yes, some of this was limited by the central bank activity also, but at the same time, I would say this was more of a balancing act also, because rupee had not depreciated that much, so it was not gaining as much in this strength, and maybe one can argue maybe now it's more balanced fact. So maybe from now on, maybe it may participate a lot more with the global movement in dollars. But that again is a question. What is the right number? And sometimes people do start looking at big figures, right? 80 is a big figure when it moved up. And would that be a new base? Nobody knows that, how central bank will believe. But at the same time, they do look at relative movement, because ultimately currencies, what is the function of currency? The currency function is to make our export competitive, and to balance it out with our relative movements with our relative trade partners, which of course largely can be Asian play, but not only Asian play. So I would say that I don't think we need to worry about too much that they will just go all out to build up reserve. I think we still have a very healthy reserve number right now. But yes, at opportunity, it's always a good idea to build up your war chest so that in time like 2022, you are able to deploy them.
You just mentioned about euro and GBP, how they have significantly bounced back, and in fact euro has seen a big reversal from below parity to where it is now. Maybe if you could throw a little bit light on how do you see euro and GBP panning out in 2023. We've got a large number of clients who also stay in the eurozone or UK, and I think they would be very keen to understand your outlook on euro and GBP.
Sure. No, so maybe as you're saying, I will pick those two currencies separately. While there were some commonalities, at the same time there were specific activities or factors which were driving those currencies. If I just pick up the common theme across both those currencies, that was clearly dollar strength and the dollar rate outlook relative to the expectation in eurozone outlook and GBP rate outlook. And it was being felt that the US economy was relatively doing much better than Euro and UK economy, which has been the case and still the case. So the ability of US economy to withstand higher rate was much better, which will mean that the Fed will continue to raise rate hike higher and for longer, and to keep rates also longer at an elevated level. That has not changed. Right, that still remains, because the outlook on the the economic growth in these countries is at a divergence where US is relatively still performing better. But maybe with the move down in inflation, what is being seen is that are we reaching peak on dollar rates? I think that is what people have started talking about. And at the same time, the outlook for further rates, how long they will keep rates higher. See, if the rates reach 5%, they remain. How long they are going to remain 5%, that is getting recalibrated. So because of that, and the outlook change, dollar is not gaining further because of that, and maybe giving up some ground. Now, if I come to the specific factor from there, let's say if you talk first from Euro perspective, clearly, I mean, Euro has been at the forefront of bearing the impact of what's happening in Ukraine. I mean, they are right there physically, otherwise they're bearing the brunt of that, and the impact on economy, on export, but more importantly on the energy prices. And that was one factor which was bearing very heavily on Europe as they were getting into winter, right? And the debate about what was happening on the energy prices, but more on the supply of energy itself and how they will be able to withstand winter. Good thing is the energy prices since have come down materially, And also, maybe while we talk about global warming and other things, etc., which will have its own problem, and the world is talking about that. But maybe for this year, that may be a blessing for Europe, because it has been quite a warm winter in that sense. So it has helped Europe to survive through this phase, right now. So the situation has become better in Europe than what the outlook or the risk and the fear which people had earlier. And coupled with the global, move up in, I would say, basing of expectation dollar, euro has gained. But I don't think some of the other economic fundamental has changed away significantly for euro. So the further uptick, yes, euro has moved, it had moved below parity, it moved back to 1.07. Further move up from there could become under more, challenging. And that I will say even for GBP. But just moving back to GBP, I think GBP clearly it was a lack of confidence given the political turmoil which they were going through, and a lot of action when we're living in a global world. You need to take around global investors, because when we talk about the foreign investment, FDI, etc., while talking about in India how they have been outflow, etc., on equity. We know what's happening in UK, and there was a complete breakdown of confidence, and that is what led to that sudden very sharp move on GBP going towards to below 1.05, and to the expectation going towards parity. Now that again, since then those things have stabilized. Some of those acts which were done by the earlier government has been reversed by the new government. There is a bit of more semblance of global investor confidence in UK. And always when currency move too much on one side, there is a opportunity. Just that when do investors come to start taking their views on that, which has taken it back to current levels. But again, I think situation becomes more challenging from here, because we already seen large bit of movement in dollar. But at the same time, dollar rates, let's not forget, dollar rates are still very high elevated level. It's just that the outlook for further rate hikes has gone down.
So moving slightly away from the Western world, the dollar, the euro, and the GBP, closer home to China. Now, one of the recent phenomena has been that China is opening up, and how do you see that impacting growth in Asia overall? Would it have an impact on investments which are like coming to India? How do you see that scenario panning out?
So I will say there are two parts. See, again, my best wishes for China. Maybe they are going through right now what the rest of the world went through, we went through, and hopefully, very soon they'll be out of that. I mean, we all have seen how the experience in India, etc. Maybe a few months down the line, things will become better over there, and then at least we are in relatively more regular situation. But yes, if they do well, clearly it's good for Asia growth. It is good for world growth also. So one of the concern, let's say right now we're talking about is world recession, right? And while in India we have decently large domestic market, and our dependency on global growth for exports is lesser, but no doubt it has an impact. So clearly, if we see things coming back normal in China, that's a good news for the world and for India, at least. But sorry, what was your second question, Shubham?
So I was saying that, what will happen is if they grow, will it have an impact on our investments here in India, right?
Yeah.
If people would check in.
Right. Yes. Now, my second part is, it's about China plus one. And I'm saying why China plus one, it is, India should be standing on its own might over there to say what kind of investment we have been talking about. So things are moving clearly over there. And I don't think it's a function of China opens up that will change dramatically. I think, see, it's a matter of time now when China comes to track, it's back, it'll be out of COVID in that sense. But the point is about the larger movement, which started way before COVID, which started from US-China trade war to say, then supply chain disruptions, and then, right now, how much you want to rely on one country from a national security, etc. perspective. So all those questions are slightly longer term in nature, which will remain, right? Which will remain, and every company, every country is discussing that and taking some steps over there. Now the degree will vary, how much you want to change that direction, how quickly you want to move. But to me, those activities have been set in motion. And from that perspective, coming into India, yes, I think we are seeing benefit, we are seeing investment at a pace and scale at which we would like. Maybe things could be even better. And that is what I would hope for. But clearly, India will see more investment irrespective of how quickly China comes back on track.
So we're pretty close to that. Let me take one last question and something which I'm sure a lot of people I wanted to ask you. We are very close to one of the most awaited events in India, the national budget. Do you expect anything to happen in this budget, which could have an impact on currency markets?
See, I would say, not directly from a currency market, but just a minute take, because that's a topic in itself. We can have full session on that. I'm sure you'll be planning for our audiences, post budget some session for that. But for me, the good part from a budget perspective, even during COVID or before, we are on a consolidation path. So normally, while we did take fiscal deficit higher in the past, the government has been trying to bridge that, and we have seen very, very robust tax collection, which has been providing very strong support in our fiscal math to the government. What I would definitely see is there is a decent bit of scope for government to support growth. The company's balance sheet in India are quite good. At retail level, the balance sheets are good, and the government balance sheet is quite decent, and everything is relative, right, in life. So I would say my main objective or hope from the budget is it will be pro growth, to provide support for more manufacturing, to the earlier point, to see how we get more investments. And when we get that, when we have growth, when we have investment, and it's all about sentiment, mind you, our global investors see. So if we see more positive sentiment, India will attract more capital, more flow, which is good, always good for currency.
As you said, sentiment is the operating word. Everyone's saying this is the last budget before they go to elections. So thanks for that, Manoj. So I'm sure, I really want to thank you for taking time out today and sharing your views with our viewers. And I'm sure there are great takeaways from today's session. Thank you to all our viewers for joining us today. We will continue these kind of insightful series to make global currency movements, simpler for you. Knowledge is indeed a fuel to growth, and we truly intend to equip you with best of the cutting edge knowledge so that you can take right, informed decisions. And thank you for keeping it interactive, and hope we were able to address your queries. We'll bring more and more such sessions. Stay tuned and have a great evening.
Thank you.